Welcome to the deep dive. Today we're pulling back the curtain on something absolutely fundamental to every business, big or small. We're talking about how they get the money they need, to operate, to grow, and sometimes, honestly, just to weather a tough patch. We're diving deep into the strategic world of short-term versus long-term financing. Think about it like this. Imagine two companies. They look pretty similar, right? But one thrives when things get tight financially, and the other just falters. Often that hidden difference, it's their financing choices. It's like the financial DNA of their operations. So we'll explore why a business might need quick cash for just a few months versus, say, a massive loan that stretches out for decades. We'll look at the tools they use, the instruments, and critically, the advantages and, the disadvantages too. Some are surprising. Our mission today, to give you the insights to understand these vital financial decisions. We'll spot some fascinating facts, maybe even some big costly mistakes along the way. But before we dive deeper, just a quick reminder that this deep dive is based on material from Farhat lectures.
All content examples and explanations discussed here are derived from the comprehensive accounting resources at farhatlectures.com. So whether you're an accounting student, maybe a CPA candidate, or already a professional, do visit the website. They've got additional practice questions, video lectures, and detailed support to really reinforce today's topic. A special thanks to Professor Farhat for providing this valuable material. Okay, let's unpack this financial puzzle then. When we talk about short-term financing, what exactly are we defining here? What kind of immediate needs, those, urgent things, is it designed for?
Right. So at its core, short-term financing is basically any borrowing mechanism where the money must be paid back within a year. Think of it like a sprint, not a marathon. Its main purpose: addressing immediate cash flow needs, managing those seasonal ups and downs in demand that businesses often face, or just funding essential operations quickly. For instance, maybe a company needs to suddenly buy a load of inventory because of an unexpected rush, or maybe make payroll next quarter, or just patch up a temporary liquidity shortfall. It's really about agility, getting money fast to keep things moving.
So it's really about plugging those immediate cash flow gaps. Makes sense. What are the most common ways companies actually get this quick cash? What do these tools look like in the real world?
That's a great question. And yeah, we should definitely talk about misuses too. There's a classic example I want to bring up later. But the tools first. Well, you see several key types. Obvious one: bank loans. But only if the term is less than a year. That's key. Then you have bank overdrafts. This is where the bank basically covers checks or payments even if the company doesn't have enough funds, up to an agreed limit, of course.
Like a safety net for their checking account.
Exactly, but for a business. Then there's trade credit. This is essentially your accounts payable. You buy goods or services now, pay later, usually within, say, 30 or 60 days. You're kind of financing yourself by delaying payment to suppliers.
Huh? Over.
It is. Then you've got commercial paper. This is where a larger, well-known company issues its own short-term debt, like an IOU, directly to investors, often cheaper than a bank loan.
Bypassing the banks.
Right. And lines of credit are super common, too. Think of it like a business credit card. You get approved for a certain amount, you draw funds as needed, pay it back, draw again. Very flexible. And finally, factoring services. This one's quite interesting. A company sells its accounts receivable. The money customers owe them.
Their invoices.
Exactly, their invoices. They sell them to a third party, called a factor, at a discount. They get cash immediately instead of waiting 30, 60 days. Or they might use those receivables as collateral for a short-term loan. So if you have $1 million due soon, factoring can turn that into operating cash right now.
Wow, okay. So that speed, that quick access to funds is clearly a big draw. What are the other big advantages then? Why opt for short-term?
Yeah, speed is definitely number one. You usually get the money much, much faster. Lenders just don't need as much time to approve short-term stuff. The paperwork, the collateral requirements, they're often less strict compared to long-term debt, crucial when time is short.
Makes sense. Less risk for them in a way.
Exactly. Which leads to the second point. Generally lower interest rates. Because their risk is lower, right? They get their money back sooner. So they charge less interest compared to long-term financing. That comparison is important.
Okay, lower rates compared to long-term.
Right. It's not always cheap money, but it's usually cheaper than borrowing for, say, 10 years. And the third big one is flexibility. You take out a short-term loan for a specific need, maybe variable cash flow, pay it back when things improve, and you're done. No long-term commitment tying you down or restricting other financial moves.
But nothing's perfect. There have to be downsides. What are the major disadvantages or risks companies face when they rely heavily on short-term financing?
Ah, yes. This is where it gets tricky. While speed and flexibility sound great, there are significant downsides. A major one is refinancing risk. These loans have to be paid back or rolled over quickly. So there's this constant need to negotiate new loans, which can be, well, a real burden and uncertain,
Always chasing the next loan.
pretty much,
Hmm.
which ties into frequent negotiation, constantly talking to lenders, renegotiating terms. It takes time, energy, resources, and there's no guarantee they'll renew or offer the same terms. Then there's the cash flow pressure. Huge pressure sometimes. You usually owe the whole amount back in one lump sum or over a very short period. If your earnings wobble, that repayment can be a killer.
Right, not spread out nicely.
No. And this leads to the most crucial point, really. It's not suitable for all investments. This is critical. Short-term debt should not be used for long-term capital investments, things that take years to pay off.
Okay, so this is where companies can really get into trouble. You mentioned an example earlier.
Precisely. A classic textbook example is General Electric, GE. At one point, they made this massive mistake. They used short-term borrowing lots of commercial paper actually to finance long-term projects.
Why would they do that? Just
Yeah.
for the lower rates?
That was the hope. They were chasing those slightly lower short-term interest rates, but it meant they constantly needed to refinance that debt, roll it over, and then the liquidity market froze up. This is around the 2008 crisis. Suddenly, nobody wanted to buy short-term paper. Banks weren't lending.
So they couldn't refinance.
Exactly. They couldn't roll over that massive short-term debt pile. It caused huge problems for them, immense pressure, a perfect example of mismatching the financing duration to the asset's life. And related to that is this simple risk of non-renewal. Even with something like a line of credit, the lender might just decide not to renew it when the term is up. Leaves you high and dry.
Wow. Okay, so that GE example really highlights the danger. If short-term has these constraints, especially for big, long-lasting projects, how do companies fund those? The massive expansions, the strategic moves. What about the long game?
Right, that's where long-term financing comes in. By definition, this involves borrowing money for typically more than a year, often many years, even 10, 20, 30 years. This is the fuel for the marathon, not the sprint. It's used for those significant strategic initiatives, buying major assets, property, factories, big equipment, or funding substantial expansions, things that shape the company's future.
Okay, so what are the common tools here, the long-term instruments? Are they just longer versions of the short-term ones?
Some are similar in name, but the scale and structure are usually different. You still have loans, of course, just with terms longer than a year, used for major equipment, maybe acquisitions, but then you have things like bonds. This is a big one. Corporations, or governments too, issue bonds to raise capital from a really broad pool of investors, not just one bank. These can range from, say, 1 year to 30 years or even longer. Lets them access huge amounts of capital.
From the public markets, right.
Exactly. Then mortgages, which most people know from home buying. Very similar for businesses buying property. It's a loan secured by the real estate itself. That collateral usually means a lower interest rate because the lender has an asset they can take if things go wrong. Lease financing is another popular long-term option. Instead of buying an asset like expensive machinery or a building, the company leases it. They get the right to use it for a long period in exchange for regular payments.
So they don't own it, but they get the use of it.
Right. Avoids the huge upfront cost. And finally, you have debentures. These are interesting. They're like bonds, but they're unsecured. The company borrows money without pledging any specific assets as collateral. So the lender is relying purely on the company's general creditworthiness, its reputation, and financial strength. Usually only available to very strong companies.
Okay, so quite a range of tools there. Beyond just the longer time frame, what really sets long-term financing apart from short-term? What are those fundamental characteristics?
There are a few key distinctions that really change the game for the company. First, generally you're looking at higher interest rates.
Because the lender waits longer for their money back.
Exactly. More time means more uncertainty, more risk for the lender, so they charge more interest. Second, and this is a huge advantage for planning, you have scheduled repayments. Payments are usually spread out over many periods, monthly, quarterly, annually. Depends on the agreement. It's not that big lump sum hanging over your head like with short-term debt. Much better for managing cash flow over the long haul.
Predictability.
Definitely. Third, security or collateral is often a much bigger deal. For large, long-term loans, lenders almost always require significant collateral to protect themselves over that extended period. And fourth, you often encounter covenants. These are conditions or restrictions the lender puts in the loan agreement.
Like rules the company has to follow.
Yeah, exactly. Things like maintaining a certain level of cash or not taking on too much other debt or limits on paying dividends. They're designed to ensure the company stays financially healthy enough to repay the loan. Breaking a covenant can be serious trouble.
Okay, so higher rates, maybe more collateral, these restrictive covenants. It sounds potentially less flexible. What are the big advantages then? Why would a business choose this route?
Well, the advantages really center around stability and the ability to plan long-term, which is crucial for major investments. The number one benefit is those amortizing payments we just talked about. Spreading the cost out over many periods significantly eases cash flow pressure compared to short-term debt's immediate repayment crunch. Makes budgeting for years ahead much more feasible.
Right, you know it's coming each month or quarter.
Yeah, precisely. And if you can lock in fixed interest rates, that's huge for predictability. You know exactly what your interest costs will be for the life of the loan, no matter what happens in the wider economy. That really helps with financial planning. Then there's the tax benefit. This applies to both short and long term, but it's significant. Interest paid on debt is usually tax deductible. So, for example, if you pay 10% interest on a loan, but your company's tax rate is, say, 30%, your actual net cost of that interest is only 7% because you save 3% on your tax bill. That makes debt financing cheaper than it looks on the surface.
Reduces the effective cost.
Correct. And finally, the big one, leverage. Using borrowed money debt to potentially boost your return on equity. If you can borrow money at, say, 7% after tax and invest it in a project that earns 15%, the difference flows straight to your shareholders. It magnifies returns.
But you mentioned leverage is a double-edged sword.
Exactly. It magnifies gains, but it also magnifies losses. If that project earns less than the cost of borrowing, leverage makes the situation much worse. That leads us right into the disadvantages.
Okay, let's dive into that other edge of the sword. What are the main risks or downsides of taking on long-term financing?
You're right, leverage cuts both ways. If you earn more than the cost of borrowing, great. If you earn less, it hurts badly. Beyond that, a key disadvantage is the higher overall interest cost. Even if the annual rate is fixed, paying interest for 10, 20, 30 years means the total dollar amount of interest paid over the life of the loan can be enormous compared to a short-term loan.
Just the sheer length of time adds up.
Absolutely. Then there's the risk of interest fluctuation if you have a variable rate loan. Rates could go up significantly over a long period, increasing your payments and messing up your budgets.
Less predictability there.
Much less. Another point is asset encumbrance. When you pledge assets as collateral, those assets are tied up. You can't easily sell them or use them as collateral for other loans. It reduces your financial flexibility.
So those assets aren't free and clear.
Exactly. And finally, watch out for prepayment penalties. Lenders often put clauses in long-term loan agreements that penalize you if you try to pay the loan off early.
Why would they do that?
Well, they've planned on receiving that interest income for, say, 10 years. If interest rates fall and you want to refinance at a lower rate somewhere else, they lose out on that expected income. So the penalty compensates them, but it makes it expensive for you to refinance when rates are favorable. It can lock you in.
Okay, that makes sense. So this really brings us to the practical side. How does a company actually decide which way to go? Short-term, long-term? It seems crucial to get it right. Let's try a scenario. Put this knowledge to the test.
Yeah, let's do that. Imagine a company, ABC Manufacturing. They're looking at financing options just to cover their operational costs for the next, say, 3 months. They've had a temporary dip in sales, need to bridge the gap. So which of these options would be the least suitable for this specific short-term need? A, a line of credit. B, a bank overdraft. C, account receivable financing. Or D, equity financing issuing new shares of stock.
Okay, thinking cap on. Least suitable for a 3-month operational cost issue. Remember that GE example, the mismatch?
Exactly. Let's break it down using what we've discussed. Option A, a line of credit. Is that suitable for a temporary 3-month need?
Seems like it. Flexible, short-term access to cash.
Yep. Classic short-term tool. Perfectly suitable. Option B, a bank overdraft.
Also sounds right. Designed for temporary shortfalls. Suitable.
Correct. Option C, account receivable financing, selling invoices or borrowing against them.
You said that was a way to get quick cash flow from money owed soon. So, yeah, suitable for a short-term need.
Right. Again, it's explicitly short-term. Which leaves us with option D, equity financing, issuing stocks.
Now that sounds big. Permanent. not for a 3-month blip.
Exactly. You just don't issue stock, which is selling permanent ownership in your company, to cover a temporary 3-month dip in sales. That's a massive, long-term strategic decision, usually for huge expansions, major acquisitions, or maybe if the company is in dire straits long-term.
Doing it for a short-term dip would send a terrible signal, wouldn't it?
A terrible signal. It would suggest deep fundamental problems, not just a temporary cash crunch. So equity financing is absolutely the least suitable option here. It perfectly illustrates why matching the purpose and duration of the financing to the actual need is so incredibly important.
So wrapping this up, what's the big takeaway for everyone listening? Whether you're running a business, investing, or just trying to understand how finance shapes companies. We've gone through these two distinct worlds, right? Short-term financing, the quick fixes, overdrafts, trade credit, and long-term, the big commitments, bonds, mortgages. Understanding the differences, the pros, the cons, remembering that GE mistake. It seems absolutely key to grasping how companies manage their financial health, doesn't it?
It really is. If you connect this to the bigger picture, knowing when to reach for that fast, flexible, short-term solution versus committing to a long-term strategic investment, it's honestly one of the most critical financial decisions a business ever makes. Get it right, and you've got the right fuel for the journey. Get it wrong, like GE did by mismatching, and you can run out of gas at the worst possible moment. It's about having the right finance for the sprint and the marathon.
So here's a final thought for you to chew on. Think about a financial need or goal, maybe in your own life or a business you know. Is it a short-term hurdle needing a quick fix, something flexible? Or is it really a long-term ambition that needs that patient, strategic, long-haul financial commitment, getting that match right? Well, it seems to make all the difference. Thanks for diving deep with us today.